Welcome everyone. Thanks for attending our webinar today. My name is Laura Baldin. I'm the head of sales and marketing for Invest. Today with me for the webinar there is Filippo Lanza, founder and the CIO of Numen Capital and portfolio manager of HI Numen Credit Fund. Ciao Filippo. Today we will address a lot of questions which we think would be very important in this new phase or new world, hopefully post-COVID. So I let you start from page 2 with a lot of say important questions that you as investor have in this moment.
Absolutely. Thanks Laura, and thanks everybody for being here with us. This obviously is meant to be as interactive as possible, so we'll leave plenty of time at the end in Q&A. But I'll just outline some of the main question that we have in front of the recent developments, both on obviously the virus side and the economic response. And we try to summarize in this page actually the main question. Obviously, the most important for us is what are the new opportunities and the new risk in what we hope is a post-COVID world. Although obviously there will be questions on that concept as well. It looks like there's been enough changes, and then we'll come up with what we think are the most relevant in terms of the asset allocation for and our strategy positioning. The second question, which I guess comes up pretty much every time I speak with any of my peers or investors, is okay, we had probably the biggest, most kind of coordinated economic shock globally in probably the most integrated economy of humankind, and still we are pretty much setting new highs on lots of asset classes, and today obviously ECB is helping in that direction. So is that possible? Does it make any sense? The third one, which is I think is a very, very important question, is who is really absorbing the shock of this pandemic? And then you could also add a couple of questions there, as in why they're doing it, and what do they want for that. The fourth question is trying to go through some of the changes, and one of the first change that we think could be possible is it's got to do with the actual economic setup. Basically, it was just a blip, like a horrible blip for a few months, and now we're going back to like a truly globally integrated economy, or is more like we're going to a new kind of setup of scattered regional superpowers. Could be the US bloc, it could be the Euro bloc, and obviously much more positive there now than 6 months ago, or the Asian bloc around China. The following question, which is very much linked to that, is this the beginning of a new super Europe? Obviously, a lot of cynical and also enthusiastic European watchers have been asking about Europe. Is it ever gonna kind of mature or grow up to the next level? And lots of people always thought that you need a big crisis for that to happen, and I think in a way we're seeing that kind of combination: a big crisis on one side, and on the other side a relatively robust, without the relative, probably a robust response from these institutional powers, especially with a plan recently announced by both the ECB and the Fiscal Authority. The last question obviously is very important for any asset allocation. Is okay, why do we even bother, thinking about asset allocation or anything? It's just, if central banks truly are omnipotent and they can do anything, you just need to buy pretty much any dip. You can get a much better computer ETF than human beings getting dragged into the emotions. And then secondly, just go along, buy everything. Really, if nothing changes and central banks are really stepping up to a much better level than 2009, why bother? Why it is really the new kind of setup, and nothing will ever stop central banks from acting or from making their action irrelevant. So those are the big question. I don't pretend to have any answers. It's more like, we're trying to, use this time to frame them a little bit and give you a bit of a hint of how we're using the book and the portfolio to position ourselves in what we think is probably the best risk reward to approach and trying to answer those questions. I think if we move to the next page, this is a bit of a historical perspective. As many of you know, we really believe in history as the driver for asset allocation long term, and I think more true than now than ever. The only difference that I think is you need to take a long timeline. Now, if you look at this chart, it's basically putting all the different plagues, epidemics in a kind of historical context over a very long timeline. When you look at these, you feel very bullish when you think about COVID-19 having a relatively small number of casualties compared to the other instances. And you're thinking, okay, maybe then the government reaction was like totally overdone. This is just an epidemic in a super media world where everybody's got information in real time, and so everybody reacts, which means we price everything quickly and people stay home effectively. So it was totally overdone. It's just a bad flu. Let's keep on moving on and let's buy everything and it's gonna be fine. If you then look at the other epidemics and things, okay, the problem with the epidemics is that you had several waves. Then you look at this chart and you get really worried and negative because you're thinking, okay, fine, if this is just a part of the movie and we're gonna have a second wave, or there is a high chance of having a second wave. I have no idea if it's gonna be a second wave or not, and I have no idea if by then we were gonna have a vaccine, which is there. Our view since our first email when this thing happened was that we always thought, and we still think, humanity eventually will win over this epidemic. I think what is really interesting by looking at this chart is to think how economic agents act now and how governments need to act in front of the economic agents, because people know. The real difference this time, and I think, particularly if you think about COVID versus the most recent, the MERS, the SARS, even the Asian flu, is the amount of knowledge that people have. And because of that, obviously they react, and the more money, the more knowledge they have. But the big, informational asymmetry that we had over thousands and thousands of years now is over. People know and people react and people price the reaction, and then governments obviously are under pressure to do what is supposed of them to do. So that's very important. So we go past this chart, but that gives a bit of perspective. Remember, that you can be very bullish or very bearish depending how you want to read it. Yeah. But one thing which I think we need to keep in mind as an investor is that do not underestimate the chance of a second wave, because from a virus point of view, that it seems like is a relatively high chance that before the end of the year we have a second wave. If we move to the next page, that goes basically to pretty much who's supporting everything, who's keeping obviously the positions up, and we know there are two big agents here that are really coming to the rescue once again. We as investors have been bailed out since 2008, and this year more than any other time. There are two big agents. One is the fiscal authority, government, and the other one is central banks. Now, one thing which is very important to keep in mind is that this is very different from 2009, massively different. The first difference is 2009, the government intervention, the fiscal involvement was minimal and only in a very few economic regions. We had obviously China, we had America, very, very little in Europe, if anything, went the austerity direction. So this is a big, big change. The second huge change is that in 2009, we had central banks issuing, printing money electronically, which is good because it's fast and is immediate, but it was pretty much done to manage a massive amount of existing debt. And if you think about that, their ability to absorb that debt and manage that debt obviously was comparatively easier than now. So the one thing that's changed now is that you don't have much of a monetization ex post, as in, okay, I'm a central bank, I go and buy stuff that's already been issued. Here you have something very different. Here you literally buying into the auction. And I think, we've seen it with in US, we've seen it in UK, we're seeing it in Japan. I think we're seeing effectively through the PEP now. It's effectively a direct, much more direct monetization of fiscal deficits out of central banks, and a very huge involvement of fiscal agency. Now, again, I look at history. When government expands, government rarely go back. So we had a lot of government expansion. We all love to be liberist and to make money because we believe in free markets. The reality, the markets haven't been free for 10 years. Now, we haven't really seen any, political, social implication of that. But I think one thing which is pretty obvious to me, I think we have a big convergence in terms of economic policy to the Chinese model, i.e. government intervention will be much bigger, government nationalization will be much more extended. And just think about Deutsche Lufthansa, think about Europe effectively suspending all state aid legislation, all competitive rules within a matter of 2 months. So historically, and that's true for any country, when government expands, they don't go back quickly. So one thing which is obvious to me is that whatever the fiscal policy we're seeing now, it'll be very difficult to go back on those. Very, very difficult. Secondly, which is again very important, the way the central banks have been involved is more and more into the direct monetization, but at the same time more and more into credit investments. So that is something that keep in mind. Again, it'll be very difficult to see that changing anytime soon. So once we see expansion of government intervention, that's there for a reason. And now, I don't particularly believe in economic theory, as some of you know that haven't spoken with me. But one thing which is probably more history than economic theory is that whenever you see the government expanding their role in the economy, there's a lot of cost associated to that. And that's something we need to look at. Now, I think central banks and government, they did actually the right thing. They did the necessary thing. And it's probably easier to say that they did the right thing economically than on what they did on the lockdown, whether it was right or wrong. I think there's probably going to be more debate on that than on the economic response. But I think from this point of view, it's very important to know there's going to be a massive expansion of that GDP, of deficit over GDP. And the one big thing for us, which is one big driver of our investment allocation, is that not everybody is going to be able to manage that. I.e., you can easily monetize your deficit day in, day out if you are United States of America, Europe, or Japan. Away from that, all bets are off. We personally do not think China is capable of doing it. And we don't think UK is capable of doing it. And then on that, away from those two, which are more kind of, in the group of eligible countries that could do it, which we think they don't, then you have a bunch of countries that will really struggle to do that. When we read about, countries like South Africa or Turkey or Brazil trying to replicate what the Fed or the ECB are doing, it's not going to happen. That it's not sustainable. Okay. And the one big thing, which is another big theme for us, is the crowding out. There's going to be a lot of demand for funding, for capital. Lots and lots of billions need to be refinanced. Central banks will be there, but remember that the central bank's intervention on a relative basis compared to the need is way smaller than what we had in 2009 and onwards. So, during the previous financial crisis, we had a certain amount of debt and a certain amount of central banks financing, direct financing. The main point for us is that there's going to be a dogfight to get funding, and we think the net amount of what governments need to issue, net of what central banks are buying, we think is a big demand of capital for the financial markets, and is much more than what we experienced for the last 10 years. There's going to be a net demand of funding, no matter what central banks are doing. So central bank seems very big at the moment, but on a relative basis, probably is not enough. And maybe that that gap is closed. Like today, we see the ECB increasing, But it may also be that we will see a lot more repricing of risk because there's going to be competition for that funding, you know. And so we remain very negative on, for example, emerging markets, because we don't think they can afford the same kind of policy mix that other countries are doing, even if they need it, because obviously they're going to have the same kind of issues from the lockdown and from the globalization. Now, if we move to the next page, I think here it's a bit of a mapping of which are the countries that we think will be more exposed. And now, I already spoke about emerging market. I think countries like Turkey, Brazil, those are the two ones that we remain short. South Africa, we are short, we stay short. We are very, very negative on those. We're very negative on emerging market in general, especially countries that have got big financing needs, because we think the cost of financing will be very different whether you are a big corporate in US or a European periphery country versus the others. We had this thought for a long time. I think this COVID is kind of a turbo accelerating that kind of situation. A big question mark of these countries, which big countries like China, for example, can they afford the funding? Can they get the funding at the right level or not? I think we spoke about enough about on these. If we go to the next one, I guess the question everybody's asking, and we asking the same, is that it's going to be temporary or structural damage, temporary or structural changes. Is this like a blip? We go back to exactly where we were like 6 months ago, or is going to be more changes? I think one big issue for me, the biggest parameter to monitor to see if it's structural or permanent is the labor picture. You know, at the moment, we had an enormous percentage of workers, probably the highest ever, being impacted by this COVID. And our thesis overall is that I think this COVID, those last 2 or 3 months, they accelerated what we always call the technological winter, which basically means you don't need that many people to do the same kind of work. And I think, unfortunately, employment will not go back easily to where it was before. Or if it goes there, the direction will be actually that gap will be closed increasingly with low quality jobs rather than very high quality jobs. I think people working remotely just realize in an organization how many people they're not that relevant for work, or how many tasks you can actually get the computers to do for you. And that's a horrible thing if we think about it, you know, from a global point of view, from a consolidated point of view, because what should have been a technological change which would have happened more smoothly, slower over the next few years, has been effectively compressed now in 2 months, because I don't think anyone now doesn't have at least one video conferencing application on their PC, which they probably didn't even know where it was before. If we then move on, I just, you know, would provide some kind of, you know, simple statistics. You know, you've probably seen plenty of those kind of charts or anything, but, you know, the point is that there is a lot of unemployment which is building up. Our concept is that during this very period of time, a lot of those jobs actually they had to be done or partially done in different ways. Now, obviously, there are sectors that are much more impacted, like hospitality, like travel, and all the rest. But overall, we think these technological winter has been accelerated, and that's not good for employment, which at the end of the day is one of the things we see there is a structural damage. It may take time. And actually, as a matter of fact, short term, I think we remain bullish, because a lot of expenditures which has been made impossible by the lockdown eventually will come to the market in the next probably month or two if everything goes well, and if there is no second wave now. I think there will be a lot of consumption that's been effectively compressed over the last 2 months. But long term, that's a real question mark we go. If we move to page 8, that's, you know, something that is important to look at, is that a lot of the sector has been impacted, actually very heavy in terms of the economy. If you look at, for example, this great McKinsey chart, they're talking about 50% of all the jobs at risk in Europe. They are effectively coming down to customer service and sales, food service, building. So, you know, the economy got really, really impacted, you know, very aggressively. And I think it's not just the lockdown per se, it's more how people will react after the lockdown. working remotely obviously will be one big thing, which I think will survive and if anything thrive going forward. If we then jump to page 9, that's one other thing that we keep on asking when we talk about valuation. Is the market overdone or no? What's going on? Obviously, we go back to, again, one of our main theme about technological winter is that the giants are taking more and more of the economy. And what are the implications of that? I mean, well, we all know Amazon, obviously, there's going to be a lot of corner shop filing for bankruptcy, whether it's Europe, America, anywhere in the world. And Amazon is taking over from them and is taking over the logistical supply chain, is going to take over a lot of the people. And, that is not something we're going back to. Now, what is interesting when we look at the market, obviously, a lot of the market push has really been driven by very few names. And if you look at like what we had in 2000, when we had the peak was Microsoft, General Electric, Cisco, Intel, Walmart. Now it's Microsoft, Apple, Amazon, Alphabet, Facebook. A few observations on that. And the first one, 2000 was much more diversified versus 2020. And then if you look into the 2020 picture where we're now, there are two other observations that I would make. The first one in this guy is actually they do a lot of what they do is the same thing, which is the cloud. Amazon make no money on delivering, whatever we keep on asking for deliveries, especially during lockdown. They make money on the cloud. Similar to them, you got Microsoft, and increasingly so Apple, Google, and Facebook. And then there is other two big issue about those, which is one is those companies, if you look at the average effective tax rate of those companies in 2020 versus the 2000 companies, you'll find out that the effective tax rate now is much lower than before. And I don't think that's sustainable with the government, with a deficit exploding in every country. So that's one big issue there. The other big issue obviously is a lot of those companies, Google for sure, Facebook for sure, and increasingly Amazon as well, they do make money on data that they don't pay for. So on one side, we have a situation which is effectively a market which is driven by the same kind of guys. They are all competing with one each other. You look at the cloud, Amazon has got more than 50% effectively market share. Can it go higher? No. Can it go lower? Probably more likely. Two, there is a very low effective tax rate, and we think taxation will be a big issue because somebody has to pay the bill sooner or later. And then thirdly, you have this issue about regulation, political issues, backlash, because there is only so much that they can effectively do just by themselves. The last observation which I would make, which put this picture together with the employment one, it's a lot of those businesses, they actually deal with SMEs on the other side, small, medium-sized enterprises, and a lot of their growth was coming from them. Let's see how many of those are impacted or not, if they're impacted on a permanent basis or not. Because again, if you look at the valuation of the market, you think they're very high, and probably they're very high because of predominantly most of those tech names. Can we stay there? I don't know. I think if I look at the picture between 2020 and 2000, just in terms of the super leaders, I see a lot more fragility there. We heard already about Europe that they're talking about digital tax to get some money. And that's one big thing also for us, for our telecom thesis. We're super bullish on telecom in general because we think that's the real infrastructure. And if you think about telecom infrastructure, those are the users of the telecom infrastructure, but they don't really pay for that. So that's something else to keep in mind in terms of our asset allocation. And I know everybody loves those names, and I'm a user, I love them too, but there is a lot of question marks on those. If we move from there and go to page 10, obviously this is the only reason why the markets are where they are. There is nothing fundamentally, we read stuff which is, I find it laughable, where people say, oh no, it's just because the present value model, we're looking at 10 years and rates are very low. So instead of 10 years, we're looking at 15 years and everything will be back to normal. So we just keep the next year, it's irrelevant. It doesn't matter. The only reason why we're here is because there are more buyers than sellers at the moment. And I repeat, at the moment, we had a super massive balance sheet expansion. And remember, this is, you know, unprecedented even compared to 2009, like I said before. But one of the things that is not in this chart is the expansions versus what is needed because the government needs to finance. You know, the last 10 years, we had this combination of expansionary monetary policy, but relatively restrictive fiscal policy or restrained fiscal policy. Or here we have the opposite. We have full expansion of fiscal and full expansion of monetary, but the expansion of monetary is not enough to absorb the fiscal. So the real question is, when do we need, when do we see a bit of an imbalance? I don't think it's there now, but eventually will be a situation where, and I think the worst enemy of the market now is if the lockdown is really successful and everything is fine, because the moment central banks reduce a little bit of pace, then I think we'll see a ripple through all the asset classes. So if we move to page 11 now, where do we see the opportunities? I think by and large, the asset classes are pretty fairly priced. As I said, you know, I think there's enough permanent damage coming, and there is enough risk of a second wave, and there's a lot of risk on secondary effect, like what is the relation between the world and China because of COVID. Then I think, you know, it's difficult to think, no matter how far you want to go and look at the earnings, to think that equities got a lot of upside here. What I think we find very interesting, we see a lot of opportunities, is stress and distress opportunities, where we've seen a lot of mispricings, and there's a lot of like special situation that we can do. Like one simple example has happened in the last few weeks was Monte dei Paschi. Obviously, as soon as European Union removed state aid, it was pretty obvious they could do anything they wanted. But those are one-off, or names like HEMA, WeWork, many names on the distress and stress side where things get overdone, or ThyssenKrupp. So there's a lot, and one of the things we're finding there is that there's a lot of industry changes, there's a lot of businesses being challenged. The COVID-19 has just been the catalyst to address what's going on. There's a lot of yield bonds are trading at distress level, some for a very good reason, and it may go down a lot more. And I think there's going to be great shorts there. Some others going to be names that got enough good catalysts to actually recover. So that's probably the area where we feel the most excited. We probably have a good, you know, 10% already on names which are probably between stress and distress. And we think there is plenty of opportunity there. Part of that, again, is the usual game, is there's going to be a lot of bailout by the government authorities. We've seen it with big airlines. We've seen it with some transportation. I think we'll see it with some, you know, others. At the same time, obviously, we have an enormous amount of money into private equity, which I think will have to be deployed over the next 6-9 months. There will also be very good shorts, absolutely. What I think now is the most interesting opportunity is definitely stress to distress. We're trying to be very cautious, very gradual, and trying to be very diversified, because, you know, there's a lot of uncertainty. But I think it's a great strategy we probably never really managed to develop or expand before, because the valuation were insane. But now I think for the first time we see a great opportunity there. And I think we're doing more work there, we're devoting more resources there, and it's something that we see as very promising. If we move away from that, again, it's going to be a bit of similar to the stress distress. We had this big discrepancy, there's a lot of volatility, there's a lot of stuff on special situations. I think names where there is something, it could be like Tiffany renegotiated with the LVMH, and because the volatility and sensitivity in the market, there are a lot of overreaction, and there's a lot of mispricing. I think one of the names we find that most compelling as being Wirecard, where there's a very rich articulated capital structure with convertible options, equity, very liquid equity, and you can effectively build a portfolio with a lot of optionality, with a very limited downside, and most of the time just that being effectively the carry you pay. So on Wirecard, we typically been running long via the convertible bonds, which provide us also the equity upside in case of a acquisition, or in case the company is truly what they're saying it is. On the other side, obviously, we've been buying put option on the equity and CDS as a way to hedge in case there is really this fraud that a lot of people think there is. We don't know, and we don't need to know. All we need to do is to run the math on the optionality of the different portfolio security. And I think there's a lot of opportunity like that. Wirecard is fantastic because I think, you know, I never find a company in my life where people have they're more opinionated. People, they either love it or hate it. And I don't know. I think there is a substantial risk in my view, and there's some numbers that don't really make sense, but I don't particularly know. What I know is that the numbers implied by the bonds and the equity and CDS are wrong. Not wrong, but they're kind of, you know, implying very different scenarios, so you can actually get in and establish a good position. So that's something else we're very active. We're going to do stuff. Telecom and wireless, I mean, this is probably the best investment that we see. We're very heavy on this sector. We just love it. We just see, I just think that one thing which has become absolutely clear after the last 3 months is that the most strategic infrastructure for any country or any company is their ability to communicate with the rest of the world and interact. And at the end of the day, yeah, we all talk about cloud, Amazon, Google, but at the end of the day, it does come down to the broadband. It does come down to the fiber, to the actual, you know, physical infrastructure. And just, you know, to make it clear, you've seen the news recently. You've seen Google is trying to get into the telecom. You think Amazon is just raised the bonds to just do another acquisition to the telecom space. You've seen obviously Facebook, you know, and Google laying down cables across the world. The infrastructure is going to be essential, and I think there's going to be a massive repricing in favor of telecoms. I think they're going to get a lot more scope from regulatory authority, from mergers and acquisition authority. I think, you know, in Europe, we had this absolutely insane policy where basically we had to have 3 or 4 operators per country instead of looking at the market on a European basis. I think France and Germany, as part of the new package for Europe, they proposed that as well. So I think we see plenty of M&A. We also think eventually we'll see a lot of repricing for telecoms versus the user of the bandwidth. So, you know, names like Netflix, Amazon Prime, you know, they use a lot of the bandwidth, and so far they've just been users through the customers. I think there will be a lot more repricing in favor of telecom operators. So it's a sector we totally love, and I think, you know, it feels to me similar to the banks in 2009, which was like, you know, you have to buy them because they are, you know, essential for the policy transmission in 2009. I think now it's going to be, and for the next 5 years, it's going to be telecom. So I think anything, and we have plenty of names there. We love Oi Brazil in Brazil. Our best, the biggest, longest Dish Telecom, Dish network, sorry, in US. They have all the 5G spectrum for the United States. This will become essential. And that's something we really focus on. And I think is probably, you know, if I have to pick and choose, you know, a few longs to keep there for the next 5-10 years, definitely be telecom, whether you go for the equity or the bonds, depending on your kind of mandate. But I think this is the most interesting place. And I kind of funny, but we do find a lot of mispricing still. You know, there's a lot of stuff which is still very, very cheap. The good thing also about telecom now, I think we will see plenty of catalysts. I think we'll see plenty of catalysts on the regulatory side. There will be a lot of, like, you know, easing up. We'll see plenty of catalysts in terms of M&A. It'll be merger and acquisition, and I think we'll see plenty of catalysts also in terms of government support and probably a repricing versus the users. Obviously, within these, you need to think about the telecom equipment makers. Obviously, it will become strategic, like, you know, the Huawei, which was just a trade issue 6-9 months ago. People now are much more aware of the issue, and I think they will create. There will be probably the most disrupted supply chain globally will be telecom infrastructure, because it will become nationally strategic and it will be treated very differently. So in this case, this is the biggest long we have, and we, you know, it's something that we keep on adding, we keep on spending time. We think there'll be plenty of great opportunity there. If we then move on away from that, where we put in the shorts, I think there's plenty of short in this market because it's just pushed up by liquidity. And as always, but now more than before, you can lend money at zero, even a negative rate at a point. But if you don't make the revenue, or if your business is collapsing under pressure from the government or taxation or anything else, it's just not going to make a difference. So we see a lot of cyclical names that really have problems, and they're very, very low spread, like printer makers like HPQ. I'm sure you printed less over the last 3 months than before. But there's a lot of names like that, and I think US is probably even better than Europe for like good cherry picking. Obviously, we're trying to buy stuff with very low beta, low spread, and trying to kind of hedge with other names. But we think there's plenty of names. As I said before, we think valuation are really full here. You need to start doing some proper stock picking and credit picking on the short side. The banks, we never really liked banks before. We don't particularly like them here now. I think we think banks will be very exposed to NPL. There will be a big growth in NPL because of SME being exposed. We think no matter what the government support is, banks are exposed because the way the AT1, LT2 structure is constructed in a way that if you need refinancing, it will be done. Is the one thing that they changed since 2009. And I think it will be used eventually, not now because everything is under, the spotlight, but eventually they will be under pressure. And I think that as a business model, the banks will be very, challenged. Within that, we really, our biggest shorts are HSBC, Standard Charter. We think their exposure to Hong Kong, they're over reliant on Hong Kong. We think they're going to get into this kind of, in the middle of this political storm. So those are big shorts that we have, and we keep on, that we view as pretty strategic. The only bank long we have at the moment is Passkey, and that's because of state aid suspension and because the NPL deal that we'll do. We think it's very cheap. We think there's a good chance actually Passkey get involved into the old UBI defense potentially. Not sure, but it's definitely a chance. Overall banks, we don't really like them, but it's not big. It's not a big short. It's predominantly HSBC and Standard Charter. We also quite worried about banks that would be very loaded with NPL, and I think again there you need to be quite picky on the choosing on the names. And then we move from that page. I think we go. This is the performance. Obviously, we had a good May. March was disappointing because we had a lot of the longs that actually came back. But a lot of the shorts that we had actually started working only later, and on some, unfortunately, we were too quick to reduce the short. This month is doing pretty well. I mean, today is a good day again because the market is going up on the ECB, and I think we had a very constructive position on periphery. We said it in the first email that we sent out after the event. We think Europe will progress fast. But as I said before, periphery in particular, we think, I don't see many other scenario different from what we think would have been all the way, which was debt cancellation. I think we investors that know us, know we've been talking about debt cancellation for a very long time. COVID is just accelerating that meaningfully. The other big theory we always had is that once Germany is going to be in trouble, Germany will be the first one to say we need to print, because historically that's what they've done. And I'm not referring to the Weimar Republic. I'm just referring to the merger between Eastern and Western Germany. There was one other time when the ECB effectively was asked to, and the Bundesbank first, ECB later, to really print. And I think now is the time Germany is really in a difficult position because they're really into the global economy. So we think will be plenty of printing out there. Now, what is interesting there, obviously, we're bullish on spread. We're not necessarily bullish on the risk-free rate, which is we think the Bund, given where the Bund is versus where US is or Japan, is very expensive if you don't really have the embedded call option on the Deutschmark, which we don't think is there anymore, pretty much, or is getting very much out of the money. So periphery is still something we really like. Obviously, we're involved with the lesser known names in inverted comma like Cyprus and Greece. our view there is that eventually DSM will be activated, and that's the other wild card the ECB has, is to be using OMT. OMT is probably the only legally robust and safe tool the ECB has, without having to be exposed again to the negotiation potential with the German Constitutional Court. So that's something we're still pretty constructive. And so that's how we build the book. We're still very constructive periphery. We're very constructive telecom. We see plenty of names to start building the shorts, and over the last few days we've been adding probably more to the shorts than to the longs, and the most active field for us remains stress and distress, or credit opportunities where we see special situations. With this, I thank you, and I think we can open up to Q&A.
Yeah, exactly. So please use the chat in the system if you want to make question. In the meanwhile, maybe Filippo, just a question from me. It seems you are a little bit less bearish than previous times. But I know that since we chat before in the last days, that I mean, anyway, you expect to have some more volatility in the market, maybe after the summer. So if you can give a little bit more a medium-term view.
I think I am very bullish on sectors like telecom, and I'm bullish on the opportunities, stress distress, which can be long or short. Overall on the market, I think the movement was very fast. What I think now, we're at a level which I think the market is really pricing a lot of good things. And I think to be honest, probably rightly so, because the best case scenario, which is that the virus itself is dying slowly and is losing that sort of killing kind of intensity, that's the best case scenario. You don't even need vaccine, you didn't even need the drug cocktail, you don't need any. Is this the virus on its own seems to be dying, or at least that's the case we've seen in some parts of Italy and some parts of Europe. So if you look at all of that, I think the market is kind of right. I think what the market is, and is also, I think the market is right on a V-shaped recovery, short term, but I think it will be very short term. I think after that we will be left with a lot of question marks. And the one thing that we think will create a lot of good short opportunities, our thesis about technological winter, good long on telco equipment, big shorts on a lot of the tech space. And on the other side, on Europe, I think our thesis is kind of proving correct, in the sense that when the core is hit, the core react, and we're seeing with Germany. That's very important for us. But also, I think once we start having a lot of countries with 150, 170% that GDP, that cancellation is the only thing. And again, the main point there for us is, if you are a corporation, you've done a lot of buyback of your bond, typically you cancel them. You don't account for that. So the only way you make the debt in Europe sustainable, if you look at that GDP excluding what has already been bought back by the central banks, and then it looks a lot more sustainable than, for example, China, in our view. So yeah, it's kind of mixed, but I think medium term now is probably a very good time to start taking some chips off the table if people manage to go long at the low, or if they recover some of the losses. I think there is a lot of names which I think, to me, they may not be as robust as we progress.
Okay, we have a question. What do you think of the relationship between US and China, and do you expect any kind of Cold War going forward?
I think obviously a big appointment, if you want, is the US election in November. And there is a lot of people that obviously think Trump will use the Chinese card to basically bring up his ratings. Sorry. I was amazed by the move by the Chinese on Hong Kong. Sorry. I think it's a very, very aggressive move, and it shows how confident or how aggressive they want to be. I think we spoke about Huawei. I think there'll be plenty of inquiries or requests to understand what happened with the virus. I personally do not think we will go easily back to where we were before in terms of relationship. Can he become a big confrontation? Probably, and I think it's part of the reason why Germany and France push on Europe is because they really need like a strong base, because clearly out there is going to be much more tense than before. So I don't know if it's going to be a cold war or not, but I think tensions will escalate. And again, like to go back to the big question we're always asking ourselves: what is the one event that central banks are not capable of managing? Obviously, one is inflation is going up. The second one is there's a crowding out of investments because there's too much demand for capital. But the third one, obviously, would be like another version of COVID-induced fear, which probably could be some sort of Cold War tension that could really slow down investments and spending. And remember, from my point of view, economies are very vulnerable. It just took us 10 years to get out of the great financial crisis. Now we just got hit by this thing, and we just we had a massive injection of effectively of a drug cocktail of fiscal and monetary. The economy is very vulnerable. It looks great if you look at the Nasdaq and the S&P, but if we have another hit, whatever it is, Cold War or anything, it could be dangerous. And that also shows why a lot of political action may be very bold, because your opponent will need to calculate very carefully if it does retaliate or not. So on that, sorry, probably a bit too long as an answer, but I think tension is definitely going to go up. And you just look at Huawei, what's happening there with the government subsidies for telecom company to substitute Huawei equipment. I think that will give you, it will be a good thermometer to see how bad is that going to be.
Cool. So at this point in time, we don't have other questions. So I think we pretty much covered. There was a lot to discuss. We are happy, of course, for the result of this year, and hopefully we will keep on going and keep on track for the performance for 2020 in very difficult markets.
Thank you for that, and I hope so too. And as always, obviously, I had a lot of conversation with some of the investors over the last couple of months. I'm always happy to have direct conversation. I can't go anywhere, so I'm at home. So anytime, either Bloomberg or emails, and we always happy to have a separate chat. Thank you.
Thank you very much. Grazie, Filippo.
Yes, bye-bye.